In the meantime, there was a flip side to a lot of this craziness. Interest rates came tumbling down today. For example, a 10-year note to which a lot of the bank rates and mortgages and home equity loans are attached came tumbling down. So mortgage rates now looking a lot more exciting. But then again, there's the issue of whether people can get the mortgages that they're applying for, and are as many applying for them right now worried about a potential financial crisis. Let's go to Tim Rood on that, the former Fannie Mae e-business group director, expert on all things banking, real estate, et al. Tim, what do you think? Now, you could argue that for a lot of people waiting, getting a mortgage out, their ship came in, albeit in the most bizarre of ways. But rates came down, mortgage rates came down. Then there's the issue of whether lenders are going to be keen on this. Where do you think this goes?
Hey, Neil, good to see you. Two things I would talk about. So look, when people are buying a house, it's generally speaking two aspects that are kind of working towards their desire to buy. So there's an economic aspect, just in terms of this affordable, and is it more affordable than an alternative like a rental? And the other part is psychological. And the psychological thing says, hey, look, man, this is the biggest investment of my life, probably. How do I feel about my job prospects? How do I feel about the economy? And things like that. The good news is that the move by the Federal Reserve or the FDIC over the weekend, really, I mean, it helped lower interest rates. So if you were looking at a house last week, just think about it in the context of mortgage affordability. Rates have gone down a half, maybe more. So that means that the cost, from an affordability standpoint, your house just got 5% cheaper, because every 1% in a mortgage rate that goes down or up is either a 10% tax if it goes up or a 10% discount if it goes down. We're going down. So I think that's a positive thing. But again, you can't get away from the fact that people are still anxious, and you have really near recession level consumer confidence, particularly as it relates to near-term expectations, which is going to hold people back a little bit. The bigger question, Neil, and you tell me if you're ready to talk about it, in terms of the lenders, of their willingness to lend, the government backs 85% of the mortgage market. So it's a not very good story that's been told. It's not been well articulated.
Sure.
But effectively, you've nationalized the housing market. So because the government is behind mortgage finance, they're pretty comfortable making the loans. The credit premiums aren't going to change. They're kind of fixed right now, so shouldn't be a problem.
Tim, a lot of people, you and I have covered these meltdowns in the past. I don't want to characterize this as a meltdown. I mean, it was for these banks, of course it was. But, that's when psychology and fear and anxiety trumps whatever the numbers tell you otherwise. And that people could look at this and say, gee, maybe we're going to go into something bad. I'll skip, applying for that mortgage, or reapplying for, a cheaper home equity loan now that I have the chance. I'm nervous. And we even saw that in a lot of, leisure stocks and all that were taken on the chin under the belief that maybe this gives consumers, average Americans, pause. Do you buy that?
Look, they're going to be anxious. They totally have every reason to be anxious. I think two of the things that are working for the housing market is even though we took a bit of a siesta last year, so as interest rates are going up, somewhere around October-ish is kind of when they peaked, a little around 7%, there was a huge pause. I mean, a palpable pause in the housing market. And so you saw people sitting on the sidelines waiting for that opportunity. Rates are going up, so that's got to mean that inventory is going to jump or prices are going to fall through the roof. Come October, they were kind of waiting, and then all of a sudden rates started to dip in January and February, and man, they hit that market hard and fast. I think with that being pulled away, I just don't see the same enthusiasm for the housing market. Now that rates are coming back down, I think it's happening fast enough that you're still going to get that momentum play, and I think that the demographics are there, that you have enough 35 to 45-year-olds, that big slug of people that's coming through the pipeline. They all have a bias towards living indoors, so we've got an inventory crisis. I think it'll be still a good year for housing. Yeah.
Real quick, a lot of betting now seems to be against the Federal Reserve hiking interest rates at its next meeting next week. Do you buy that they pause?
I've kidded before that I thought that Jerome Powell was about as independent as my 16-year-old. Look, he's shown that guy can tough talk a mirror, and he's walking the walk. But right now, you're basically looking at a binary choice. It's like, how badly do you want to save the financial system? It's probably okay, but maybe not. And then ultimately, how hard do you want to push on the inflation side? It seems like we've gotten to a breaking point. A pause makes sense. I think the responsible thing to do 25% so that you don't throw away basically the anti-inflation playbook and you go back to the 1970s where it's going to come back. So I think 1/4 a point is just that right balance, and then back off and take a long pause like the Bank of England.
All right, we shall see. Tim, always great catching up with you. Best of luck with your 16-year-old son. That's a great analogy. Tim Rood.